So just to reiterate that, so that makes it very clear, this 100 grand, you've got to be able to add £100,000 worth of value in 6 months. So that's pretty huge. No planning, maybe PD, but basically no planning. And then you've got to net 3 grand rent a month.
That's my criteria. Yeah.
So interesting question. So Alan's just asked, can you give a price range that you might be looking at within that? I mean, obviously that's going to depend if you're up in Chester or down south, but is there generally what you're seeing in an area? Are you looking at similar prices for this kind of unicorn deal?
Yeah, totally area dependent, right? So it is going to depend on where you're investing. To give you an idea of the sort of things that we do, we're kind of in purchase 300 to 800,000 pound bracket are the sites that we're buying. We have one of my strategies called Sparkle, which is like a mini unicorn, which is generally a commercial, smaller commercial, like a restaurant, cafe, something like that, hairdresser on the ground floor, and one flat above. And there are certainly areas in the UK you could buy something like that for sub £100,000 still, and that's a great place to get started if you're happy to invest in those sort of areas. In fact, I'm looking at divesting a couple of mine that I bought 10, 12 years ago, which have gone up in value a lot. So again, we talk about the equity. There's a lot of equity sitting there. I want to put that to better use. So we're looking at.
Everyone's looking to buy something. Rob's got some for sale.
Yeah, I mean, obviously, they're going to be market value sales, so it will just be a return on investment for somebody who wants to park money rather than do the active strategies. But there's always that market out there buying it, isn't it? So it's not going to be sold at a discount. But yes, I always look at selling. We're looking at selling some of our bigger ones as well, actually. So we're in a process of selling a block of 13 and a block of 9 as well. Again, just because we've had them for a long time. Let's be honest, the last, whatever mainstream media says about, property prices coming down, all that sort of stuff, there's been a lot of equity growth over the last 4 years or so since COVID. So, yeah, we've got quite a lot of equity in some of the properties.
Fantastic. Yeah, I mean, there's definitely been, we could never have imagined, could we, at the beginning of COVID, to imagine that we would be, the property prices would continue to sort of go up the way they did. So it's pretty amazing. So yeah, tell me a little bit more about your apart hotels. Having got an apart hotel myself, I know some of the major benefits, but equally, like all strategies, there are some downsides as well. So yeah, tell us a bit more about your apart hotel model.
But before I do that, can I just, Alan's put a question in there. He said 300 to 800 is scary. And then if it all goes wrong, life is over. So it's a really good question, Alan. And I want to give you my thought process. So when I'm appraising deals, everything is about risk mitigation. Okay. So for a start there, I always have to have at least 3 exits to that deal. So I'll have my plan A, my plan B will be, right, if I can't do this, what can I do? And my plan C will be, if I can't do anything, can I just flog it and still make my money back? And something that we need to understand with property is it's a secured asset, right? So it's not like we're sticking 300 to 800 grand in stocks and shares, which could go to zero overnight. There is an inherent value and always will be an inherent value in the property we're buying. Of course, people make losses in property. Generally, the losses that I have seen, sorry, my dog's going now. I don't know if you can hear
it. We'll ignore them.
Generally, people who lose money in property is because they've loaned money incorrectly without the right security in risky development deals where the developer doesn't know what they're doing and gets the figures wrong, which is precisely why I don't go down that route anymore. Go down the property unicorn strategy, which mitigates all of that risk. You're buying an inherently valuable asset already, which is going to be below where it's worth. So that's really important to mitigate. And when I work with my clients, we do weekly deal appraisal. And most of that deal appraisal that I do is going through that risk mitigation process, making sure that everything is covered, no stone is left unturned, to make sure people don't lose money. And if you do it right, you should not be losing money in property. So there is that inherent value. So I don't know if that answers the question and hopefully gives some, so whether you're buying something for 100 or $1 million, it shouldn't matter. It's a secured asset, which you're going to have. If the security is done correctly, there should be very, very little chance of you losing money on something if you do it right.
Absolutely. And I think going back to sort of Alan's question, it's for me, it's all about getting the foundations right. It's all about ensuring that you're not just guessing. So the number of people, you know, I know there's a chap local to me, our local commercial agent said, can you go and have a chat with him and help him out? He bought what I think will end up being a really good mixed use property if he does the right thing with him. But he hadn't even read and he bought it at auction and hadn't even read the auction pack, you know. So that is, you know, if all goes wrong, there's a reason for that.
Yeah.
But, you know, I know Alan as well, you know, he's going through the process of really understanding what he's doing. He's really putting the foundations in, understanding his area, understanding the strategy that he wants to do. So as you've said, you're then mitigating that. What we want to get to the stage is there are going to be things that go wrong, but we want to reduce them. We don't want them to be £1 million mistake. We want it to be a mistake where, you know, perhaps, you know, the tenant is slightly less of a good yield. You know, so it's not really, you know, we're talking about, you know, you could have maybe made a bit more, but you're still got a great cash flow. So let's say you're earning 2,800 instead of £3,000 a month. Well, that's no great terror, is it?
Yeah, exactly.
So it's, yeah, so I think it's sort of getting those things. So yeah, Alan said makes sense.
Okay.
So yeah, so going back to the apart hotels, tell me a bit about, you know, how you got into it. Does it work for you? For me, I love it, but obviously where I see the downfall with that is just the refinancing. It can take 2 to 3 years, so it is definitely that kind of longer model.
Correct. Yes, totally agree. And I think this is a common misconception in the industry, and finance is always one of those hot topics, right? Because it's so easy for a property training company to say, you know, go and turn something into an HMO or an apart hotel, get a commercial valuation, pull all your money out, right? And so people get half the picture. And I remember there was a massive phase of it sort of 10 years ago, 2014, 2015, when I was sort of, you know, getting into training myself, where the word on the street was you just go and buy a three bed house with 2 reception rooms, stick beds and wardrobes in the 2 reception rooms. You've got a 5-bed HMO, go and get a commercial mortgage on it and pull all your money out, right? Absolute rubbish. Just doesn't happen. I remember having a heated argument in a session with a mentee once for a big training company. Was like, no, I've been told that this is what you can do. I'm like, trust me, no bank is going to lend you commercial valuation on the income because you put beds in the living room and the dining room, right? You have to do material changes to that thing. So I feel there's some bad information out there. Serviced accommodation, if you're going to get it valued on the serviced accommodation income, as you said, you will need 2 to 3 years worth of signed off accounts, right? Filed with Companies House, that the bank can look, because effectively you're in business lending at that point. You're not in property lending. So I do a lot of stuff with Lloyds. What we do is when we buy it, they will value it based on the AST income, the assured short hold tenancy. They know they're perfectly happy for us to short-term let, but they're like, look, we value this as if we have to repossess. We're not going to be operating it as an apart hotel or a block of service accommodation units. We'll just be valuing it as if there are long-term tenants in there, and that's what we can sell it on for, right? So that's how they're going to be doing that risk mitigation. Then 2 to 3 years later, they'll pass you over to the business finance team, who will then look at giving you a commercial valuation based on the actual income. And again, this is really important, the actual net income, not the gross income on a serviced accommodation unit. Nobody's going to lend on gross because you've got probably 50% plus worth coming out of that. So you need to understand that as well. So that's the finance. And that does make it a little bit more tricky to structure if you are, if you're looking for quick recycling of cash, right? Or you're working with other people's funds, you know, JV investors, and you're promising them you're going to recycle the cash, you need to understand those considerations. The actual model itself, I love, right? So the serviced accommodation industry is going through, or it will go through over the next couple of years, I would say a lot of rationalization. There's obviously a lot of, there's consultations going on with both licensing and planning, you know, changes. So what will happen, or can't guarantee it, but I saw all of this happen with the HMO market about 10 years ago, when you get the C4 planning use class come in, permitted development rights, then Article 4 comes in, licensing schemes. The same will happen with service accommodation. So I don't see that as a bad thing. If you're operating properly, you've got units that are designed to future spec, and would, you know, you're happy you get sort of sui generis or whatever, you know, planning they'll put in. you're golden. So everything that we do as a part hotel will go through planning, we'll get it stamped, and then it's done, right? We don't have to worry about planning changes. It'll get done to the correct building regs with, the correct fire systems. It's all done. So we're not scared of licensing. Yes, there's another cost you've got to get in. And I think all of that change in the industry, what it will naturally do is flush out a lot of the sort of maybe the more amateur operators, dare I say it, and I've got no issue with rent to rent. There's a lot of people who get into the rent to rent side of things, rent to SA. I suspect margins will be, compressed to quite a point. So a lot of those operators might struggle as well. Sorry if you're doing it at the moment and going, Rob says it's not going to work anymore. It all depends on the figures, but I know a lot of people overpay for rent to rent deals. But when you are operating it as a business, and SA for me is a business, right? It is a trading business where you should have a brand, you should have a USP, you should position yourself in a certain place of the market. If you're doing all those things, it's a fantastic cash flowing and lucrative business model if you're doing it in the right way. So I absolutely love it.
I like it. Definitely. So your apart hotels, just to understand, are they C1, or do you have more of a sort of a sui generis kind of model?
Yeah, so at the moment in the blocks that we've got, they're actually pre-existing flats that we've then sort of operating that block as so I would say that's not an apart hotel per se. We've got a couple of units, 3 units at the moment. They're actually going through planning for this. It's actually a very good question because there is no use class for the apart hotel. So my understanding is it probably should sit under sui generis, but whether it's C1 or not. So we've got a unit that we have that is actually C1 already, and we've got the plan. So we own it already. We actually operate it as a large HMO, but we are putting planning for a 10-unit apart hotel. Even the architect's not quite sure. Do we keep it at C1 or go for sui generis? And that's just going to be a consultation with the planners. I'd have thought, but we're kind of going down tangent here. But this has got loads of interesting intricacies in terms of things like capital allowance claims. All of that sort of stuff about what you can and can't claim for. Is it a hotel? Is it a sui generis? It's kind of an emerging class, isn't it, the apart hotel? So I think it's an exciting time to be part of it because it's almost an industry that's been carved out at the moment in terms of planning, legislation, regulation, all of that sort of stuff.
Yeah, I agree. I think this, where they go with the serviced accommodation licensing and, potential planning rules, how they're going to get that out, I think that will really show how that route's going to go. And I think we can only guess at this stage.
Yeah,
so
correct.
yeah, completely. So another thing that you've spoken about is you've got into kind of looking at business buying. And inherently, I think it is really important, and you've raised it a number of times, that we are running a business. And it's something that I do talk to a lot of people. A lot of people just sort of think, oh, I'm just doing property on the side. But actually, it really is a business. And you rightly said, if you've got rent to rent service accommodation, that is purely a business. You don't own property. So it's not a property business. It's purely a business. But along the way, when you're sort of running this business, you then have talked about, you did some more understanding of actually business buying. And I've done that myself, so we'll have a chat afterwards who we went with. But you've then talked about how this has enabled you to structure deals in this more creative way, even more creative than we already are in the property world. So could you just tell us a little bit about how that has helped you actually understanding more about the business world and the business environment to be able to be more creative when purchasing these properties?
Yeah, for sure. I mean, a unicorn property is effectively its own little micro business anyway. So the way it's valued, all of that sort of stuff is different to normal bricks and mortar. One of my favorite strategies is called balance sheet hacking as an acquisition tool to buy property. And this is where effectively, rather than buying the property, you're buying the business that the property sits under. Now, there are quite specific sets of criteria we look for. So you're generally looking for just a holding company. It's easier if they're unencumbered. If there's lots of properties in there, it makes it, probably different considerations. But there's quite a lot of limited companies out there that just own a single asset, a single property, very often unencumbered if it's been owned for 20, 30 years. And that gives us a great opportunity of buying the business, and we can structure it in a way where when we start manipulating the balance sheet and tax liabilities that sit on the balance sheet of the limited company, we can actually buy the company for way less than the property's worth within it, which is a really nice way of being able to recycle capital quickly, because I'll give you an example. So one we bought.
Can I just say before you give that example, I want
Yes.
to repeat that. So what Rob is saying here, that you buy a business with you basically buy a limited company with a property inside it. So even if the property is worth £400,000, he might be buying the business for £300,000, even though there's a property inside it for £400,000. I wanted to just reiterate that in case nobody heard that, because this is so incredibly clever, but really important. So sorry, yeah, do give your
absolutely spot on, and thanks for highlighting that. And those figures actually are really good figures to use. I was going to illustrate using exactly those figures actually. So 400 to 300. So
I have done your course, Rob. Remember?
What's that? Sorry.
I have done your course, Rob.
You have. That's it. So it makes it a great way of recycling capital. So example, let's use those figures. So one of my holding companies bought the business, shares in the business with the property inside it. And let's say the property is worth 400 and we bought it for 300. And the reason, if anybody's wondering how do you do that, it's due to the balance sheet position of the business you're buying. And property own, businesses that own properties are going to have deferred provision for corporation tax based on the value increase of that business. I don't want to go into any more detail on this session than that, but just trust me that because of the tax liability of the business, we can effectively knock that off when we buy the business. So let's say you're buying a business for 300,000 and it's got an unencumbered property within it that's worth 400,000. So my limited company will, in cash, you could do this bridging other people's money. Difficult to do it with finance, right? You're going to need to use a bridge or other people's money or your own money if you have it. Buy the business. On the same day that you buy the business, you can then refinance the property that's within it. So let's say the property is worth 400. Let's just, for sake of argument, say you can get a 75% mortgage on it. So you're going to pull 300,000 out on the refinance, which goes into the bank account of the business you just bought. The business you just bought then lends that money back to your main company and replaces the money you just used to buy that business, right? So it's a really nice way of recycling capital very quickly. And then when you mix it with some other strategies, you can actually increase the value of the property within the business on day one as well. We use some strategies like lease re-engineering, yield compression. I know I'm just throwing these out there and not explaining them, but just for the purposes of this, just assume that we can do that with various mechanisms, which is a really nice way of recycling cash. Now, that money is not coming from nowhere. We're not getting rid of that 100 grand, or we're not just making 100 grand on day one. The tax liability is still there. So if the company sold the business, if the company sold the property in the future, it's going to have to pay that. But if we don't sell the property, we're never going to have to pay it, right? You only crystallize that tax liability when you sell. So if it's for a long-term hold, you're not planning on selling it, it's just going to sit there on the balance sheet as a deferred tax liability, which never has to get paid.
So guys, I would suggest you go back. There's not many people that I suggest this. Re-listen to this and put it on 0.5 times because Robert just covered some incredibly complex things in there, but incredibly important. So again, this is where it comes back to, you don't know what you don't know. And I do feel in anything that one does, whether it's you need help with your mindset, whether it is you need help with your strategy, whether it's whatever it is, do get help, guys, because these are things that you could be missing. They're on your fingertips. You've got this great deal, but you don't know what these opportunities are. So it's, it really is very, very important to go out of your way to constantly be learning. I mean, I'm just a literal learning junkie. I just love any kind of new things. So immediately I met Rob, I'm immediately onto his courses, just hearing what other people do, whether they structure it. And it may be just one nugget that comes from that completely changes a deal that you're doing. So I think it's really key. So with that, nicely segues into, I know we've really done. Yeah, is tell us a bit about, so obviously I've got your book. You kindly shared
it's not mirrored. There we go.
some other bits. So tell us, how can people come and find you? What's the best way? What do you have on offer? Please plug as much as you want.
Okay, it'll be a very, very, very brief plug. Look, I'd say if you want to know more about property unicorns, the best place to start is that mirrored book called Property Unicorns. There is a link. I don't know, Emma, if you're able to post a link to it somewhere.
Yeah, we will do a link definitely.
We'll post a link. It's free plus postage and packaging, so it's £4.97, I think, postage and packaging, which gets it through your letterbox. And then within the book, it's going to go through detail everything I've just spoken about, right? So it's going to talk about all the strategies, going to talk about all the value add mechanisms. There's a huge amount of value and content in there. And then if you want to find out more about my ecosystem, there will be ways that you can, sort of reach out to me through resources within that book. So I'd say that's the first place to start.
Yeah, so already we're being asked for the link, so definitely you send that link to me, Rob, and we'll get it into this, and we'll also share it as well. I do usually do some follow-up stuff as well.
Can I share it on here at the moment? Is there?
Yeah, I mean, you can just chuck it into that, but because we're on multiple
okay.
sites,
We'll just post it under the thing, shall we?
Yeah, it might not, but it's worth popping it in if you've got it. And then
I put it into that private chat thing. Sorry, I've not used Restream before, so I'm just.
There's just like an R just beside where it's got R, and it just drops down. Just chuck it in there, and we'll see what it goes out to.
No, that's gone in private chat. That's it's all right. Don't worry about it. We'll put it in. I can't see where else to put it. That's fine.
Okay, so you might not. I've got this here. There you go. I've put that in. So
there you go. Got it.
So that's at least gone into a couple of them. There we go, Alan. So you should be able to see that as well. So brilliant. So Rob, I really, really appreciate you coming here. I do love talking to people that see the world perhaps a little differently to others. I suffer from that Malay as well. I seem to look at things very differently from others. But I think it's really key and really important. And you do hear, don't you, whatever the masses are doing, you do something different.
Mm-hmm.
But that certainly the way you structure things, I absolutely love it. It needs a bit of learning. It needs a bit of sort of educating, but it's not out of reach of people who, are not that experienced either. So it is just literally, getting that support again. So I really appreciate your time. So if anyone hasn't done it, we're putting the link in. Go and buy Rob's book and follow him through. As I said, I've done one of his courses and I really enjoyed it. There were some really good nuggets in there. So wherever you are in your journey, it's worth a follow. So yeah, Rob, over to you for any kind of closing comments for anyone who is listening.
Look, closing comments. This is actually really simple. Simple is rarely easy, but I actually find doing this much more simple than a lot of other property models. And everything that this is designed for is to go 80-20. So it's designed to achieve more with less. And after doing this for 15 years, there's two ways of doing it. Number one is you can hustle and grind and go down that route, right? Which is what a lot of people seem to wear like a badge of honor. Or you can go down the simple route and build an ecosystem that's way more hands-off, not completely passive, just doesn't exist. There's going to be some stuff you've got to do, but way less work, way less risk, more actual net cash flow at the end of the day, right? With a smaller, more perfectly formed portfolio. And that to me is what property should all be about.
I love that. I'm writing that in. Achieve More with Less by Rob Stewart. Thank you so much. Thanks so much, guys. So please do. We're back again next Monday. I know Tuesday, we occasionally do a Tuesday session, but we're back on Monday and we're going to be talking all about tenants next week. So yeah, if you are into tenants, if you want them, and especially with the renters' rights that's coming up. So we've already had books ordered here, so that's great news. But yeah, we're going to be covering that off next week. So again, Rob, thank you so much for joining us today. Really, really appreciate that. And yeah, look forward to catching up very soon. Okay, guys, thanks so much.